Hey, good afternoon, everybody. You are listening to U.S. Home Talk. We are live every Wednesday at noon Central Standard Time. Well, we go live at noon if I'm not late to the show like I was today. Today we're starting a little late. I apologize for that, but we're here at noon every single Wednesday Central Standard Time talking about mortgages, real estate. We talk about some credit repair, and we also field any questions that you guys have when it comes to mortgages and real estate across the country. On the show with me today, no stranger to U.S. Home Talk, is Marcus Walgrave with Hegg Realtor, the South Dakota Home Team. I'm Mike Overson with Luminate Home Loans. Jason Walgrave is usually with us as well, but he is gone today. So it's going to be me and Marcus running the show. So what are we going to be talking about today? We're going to be talking about, well, what the heck is happening with interest rates? You know, because that's been a topic here that we've been navigating for about the last month. Because if we do rewind a month ago on September 18th, the feds came out and said that they were going to lower interest rates, right? But what has happened to mortgage interest rates, which they did. They did what they said they were going to do. But what has happened to mortgage rates since then? Mortgage rates have gone up almost 0.75% since that announcement. So everyone's like, hey, whoa. You said that rates were going to go down. Mike, why are you telling me that rates are higher now? So that's what we're going to talk about on today's show. How many calls have you got like that recently, Marcus?
It definitely comes up, especially with like first time home buyers. You know, they're just not really familiar with what's going on and the process of everything. But when it comes to like clients that I've been working with for a while, or clients that I know are working with mortgage professionals like yourself, an expert in it. A lot of them have been coached about what's going to happen. Yes, the prime rate's going to come down. However, you know, this is what we're going to kind of be discussing here in today's show. So, if they're new in the market of buying a home, first time home buyers, maybe even second time home buyers, and the process is very fresh to them, then yeah, a lot of questions, a lot of like, you know, concerns and confusion. So, but hopefully we can kind of cover that today.
Yeah, we'll certainly cover that today. You can join us and ask your questions to us live during the show here. We do have a real estate hotline or a show hotline here. That number you can see scrolling at the bottom. It's 612-234-7585. Feel free to text your questions to that number. Again, it's 612-234-7585. If you're catching us live on Facebook, you can go right on the chat in the comment section there, and you can type in a comment or a question right there on Facebook Live, and that will come to us as well during the show, and we'll answer those as they come in. All right, so let's get into interest rates. So in general, I'm going to try to explain a little bit how this works. So in general, what the feds have control of are short-term interest rates. So we're talking about auto loans, credit cards, home equity lines of credit, personal loans. Those types of loans, those types of interest rates, that's what the Fed has control over. So when the Fed came out and said, hey, we're going to lower rates by 0.5%, those rates on those particular types of loans, they did go down 0.5%. So everyone who's got a home equity line of credit, anyone who was shopping for a new car and was looking at auto loans, if you hadn't, closed your loan on your auto loan during that time, your interest rate would have been 0.5% lower. You know what I mean? So if you waited a few days, I'm guessing people who were car shopping there, their banks and stuff might have been like, look, if you wait till after the Fed meeting, if they do lower it 0.5%, your rate's gonna be 0.5%. Do we want to wait a few days, right, to buy this car
Yeah,
and take
right.
advantage of that?
Makes sense.
I'm sure there was probably a lot, right? I'm sure auto loans on the Friday after the Fed meeting was probably a huge day to close auto loans, because I'm sure a lot of people were probably just waiting for that announcement to happen and those rates to come down.
And it wasn't any secret, Mike. I mean, they've been hinting towards this for months, right? I mean, you know, there was even talks of maybe this happening as far as back as spring, but you know, inflation's been a bugger. I think it'll continue to be an issue that drives the prime rate. But I mean, you know, the reason is because like what you're saying. I mean, it's an economical driver. You know, if people see that they can now buy that car and at 0.5% less, and then that monthly payment, if they're looking to finance that vehicle, over 72 months is $50 cheaper or $100 cheaper because the rate is less. They're like, okay, let's make a move on it now, where maybe they were sitting in the sidelines. So that's kind of the concept behind it, is to drive economical activity.
Yep. And so what happens when, and those are all short-term rates is what we kind of categorize them as. What happens to long-term rates when short-term rates go down? Well, it's kind of like on a teeter-totter. When one goes down, the other goes up. So what we saw and what we are experiencing now is that our interest rates now are higher because short-term rates go down. The immediate reaction of long-term rates when the short-term rates go down is that the long-term rates go up. Now, does that last forever? No, it doesn't last forever. Eventually, those lower interest rates that you see on those auto loans, on those home equity lines of credit, on the more personal financing side of things, that'll trickle through the economic system, and then it will start pulling our mortgage rates down with it as well. It's obviously not immediate because we're still in the increasing interest rate rise here, and the Fed announcement was about 5 weeks now, but it will take effect and it will start coming down. And I do believe that as we look through November and into December, once we get to the end of December, our rates are probably going to be a half a percent, maybe even a full percent lower than where they're at today. So I still think that is reality and is realistic for our situation.
Definitely forecasted, right? I mean, you see a lot of our top economists, and that's what they've been kind of saying here. Hey, probably by year end, we're going to be hopefully close to that six flat, maybe the high fives. That's been forecasted. I think just Mike, you're a former college football star, and you've always used the analogy of that when this event happens, it's kind of like a juke move, right? It goes a little bit to the right, but then it ultimately is going to shoot to the left, and that mortgage rate kind of goes up a little bit for a couple weeks, 2-3 weeks, and then it comes back down to the direction that it's supposed to be going. When we see these rate cuts, so a little bit of a juke move right now.
Yep. Yep.
Don't
And
be
then we
fooled.
get, you get jobs reports, and you get there's other factors too. It's not just this that affects mortgage rates. There's other factors in the economy that are driving some of the increase in interest rates right now. Inflation is one, job report is another one. But
World events.
the cool thing is we got some potential big market movers coming up. We got the election on November 5th. We have the next Fed meeting is going to be on November 6th and 7th. So we have back-to-back potential, pretty major market movers here that'll come up. So I'm curious to see what that does for interest rates there. And does it start swinging it? I think the markets could be bouncing around for a few days after that. But again, if we kind of look forecasts in the future, get to the early mid-December and even late December, I think we're going to have kind of a nice, slow, steady decrease of mortgage interest rates happening.
I've heard Lawrence Yun, who's the chief economist for the NAR, present twice in the last 30 days. One was at a convention of the Dakotas in Bismarck, North Dakota. And then recently there was a Realtor Association of the Sioux Empire YPN event that he came down to in Sioux Falls. And that was his forecast, was like, hey, the day after elections, the feds are going to meet, and is very likely that they're going to reduce the prime again, because they just don't, historically, they don't do one reduction. It's always several reductions, 3, 4, 5, 6, maybe up to 8. Is it likely that we're going to see a half point cut the day after election? Possibly. But they may kind of, tailor it back a little bit and start doing some quarters or something of that nature. But yeah, man, that's again forecasted, right? That no real secret what they're planning on doing on the 6th and 7th.
Yep. Yeah, and it's funny, and I have that graph there, Evan. I don't know if you can pull up that graph, but if you go back for 3 years, if you look at the last, I actually have the last 4 Octobers circled on that. Go back to the other one there, Evan. Yeah, go to that one. So I circled, this is the mortgage-backed securities market, going all the way back to 2018. Now I circled the end of October for the last 4 years. So the far right circle is today, right? That's late October of 2024. The next circle to the left is late October of 2023. The next circle to the left is late October 2022. And then the far left circle there, you can see that's still COVID years, right? So we kind of throw that out because COVID was just, nothing was normal back then.
Yeah,
It was everything was
say
just
about that?
Yeah, it was a complete
Strange times.
outlier, right? And in a statistical deal, you would never use that because it's such a far outlier that you wouldn't use that in statistics. So, but if you see on this chart, the late October, right, especially in 2023 and 2022, right, the market is at its worst point in late October for both years in a row. And now we are in 2024. We're not quite at the worst point of the year, but we're at the worst point that we've seen for several months now. So everyone's like, is there some sort of correlation with the October effect with interest rates? We're going back, to 2022, late October, we had the worst rates that we had seen for the entire year. 2023, worst rates we had seen for the entire year. Now in 2024, we're back in that slump, if you will.
Yeah.
I don't know
But
if
like you
there's a
said,
rhyme or
kind
reason
of a
for it,
unique
but
year, right? It's an election year, so
yeah,
maybe it's safe to say that this October is not going to be similar to last year or the year before because of a presidential election year.
so yeah, it's just funny kind of how that works. So I guess the point I'm trying to make there is I do just see this as just a blip on the radar, right? Rates are going to go up a little bit, right? We had some economic factors happening. We got the election and stuff coming up. Again, we kind of get past this, 2-month little span here where rates might be a little wonky because of those things. But I think we're going to be able to see and experience a nice steady drop in interest rates. Once we hit December, January, I think it's just going to be a kind of a nice steady float down from there.
Long term.
Long term. Yep. And it's never a straight line. We've spoken about that before in this show, right?
It
It's
used to be, it felt like it used to be, Mike. It seemed like
it
it
used
was
to not just
I
move
feel like
at all.
2018. Remember like in 2018 when it would that the mortgage rates were moving about a quarter every quarter. It was like,
Yeah.
oh my goodness, I can't believe how fast it's moving. Now it's like eighth every day, up and down, up and down, up and down.
Yeah. Yeah, I mean, just look at the chart. Look how boring that chart is. You go back to, the back half, the left half of the chart there. I mean, there's just not a whole lot of movement.
Yeah,
Look how small each one of those little tiny little candlesticks are, and then you get the big peaks and valleys on the right side of this chart, and that's the last 2 years, just the ups and the downs and the ups and the downs. So, well, we knew the COVID stuff couldn't last forever, right? I mean, there's no way that could have sustained. It was a nice run while we had it. We're back to kind of normal now, though, to be honest with you, we're sitting at around 6.5, 6.625 roughly on 30-year fixed rates today. Pretty normal if you look at the average for the last 30 to 40 years.
good time to buy
Yep.
if you can lock into a 6.25 or possibly a 6 or 5.75 here in the upcoming months. I mean, what a great opportunity.
Yep. Evan, do you want to bring up the text part of that you had up there previously? So there's some other commentary in here, which is kind of nice to you kind of look at it. So the other side of this is investors and where investors putting their money. So when the Fed basically comes out and everyone knows what they're going to do, right? This last meeting, everyone knew they were going to drop rates by 0.5%. And we knew that 2 to 3 months beforehand. This next Fed meeting coming up, we know that the Feds are going to drop rates again, probably 0.25% this time, maybe a half, but more than likely a quarter. But investors know that that's what's going to happen, right? So now they can make their play because they already know the future, right? It's almost kind of like betting on a football game that you already know the outcome on. It's a pretty safe bet because you know how it's going to turn out. Investors know how this is going to turn out. Rates are going to go down a quarter, maybe a half, but a quarter. And so then they put their money in different spots, kind of knowing how the outcome of that game is already. And so this talks a little bit about how some investors are oversaturating the treasuries market because they know the treasuries market is going to come down by 0.25%. So, and when money goes into treasuries versus into bonds, right? As the liquidity goes from one to the other, if the liquidity was going into mortgage bonds or mortgage-backed securities, our interest rates would be coming down. But now investors, they want to buy up the treasuries because they know where it's at today, right? And that's a 10-year play. I go buy a 10-year treasury today, and I'm making a yield of, let's just say, 4.5%. I know that same treasury, if I wait 3 weeks to go buy that after the next Fed meeting, I'm only going to get 4.25% for my return on that. And so a lot of investors right now are putting their money into treasuries knowing that now I can lock in a 10-year deal at, let's say, 4.5%. And then anyone who buys that same treasury, like I said, 3 weeks from now is only going to get 4.25%. So I can make my safe play. I can make 0.25% there, and it's extra if I make the move now versus later. And so some money, some of that liquidity is coming out of mortgage bonds and going over into the treasuries so that the investors can make that play. Well, as liquidity comes out of the mortgage bonds, interest rates go up. So what we need to happen is we need more liquidity to get thrown into the mortgage bonds. As that happens, then our rates will come down because there's more money than placed on the bond side of things.
And that's what they were doing during COVID. I mean, they were forcing that liquidity to keep those rates at that 3%, where we were sitting for so long. But sooner or later there's kind of needs to have your ebb and flow and just kind of a snapshot of time right now.
Yep. Yeah, and if anyone's heard the term quantitative easing, so the government used to throw money into the mortgage-backed securities. They would buy mortgage-backed securities or mortgage bonds on the back end, and to the tune of a couple $100 million a month is what they would buy, right? And they can kind of artificially lower interest rates, mortgage rates, mortgage interest rates because of that, because they're pumping all that liquidity in there and they're buying there. So everyone investor is like, hey, if I invest in these mortgage-backed securities, the government's going to buy it. I got a buyer right there, right? I know that asset is worth something and I have a buyer right there. I don't have to sit on it and see if that asset, value goes up or down. I can literally invest in it. And if I want to, I can turn around and sell it to the government because they're buying $200 million worth a month right now. That helps pull interest rates down because of that additional liquidity in there. Right now, the government is not doing that. And so now it's just free market, basically, that's going to be dictating rates. Can the government step back in at any time and say, yep, we're going to go back and we're going to start buying mortgage-backed securities? They could if they wanted to, and that's all part of their grand economic scheme of things of what they're going to do. They're looking at different sectors like, hey, where do we put our money? Where do we need to put money into one or the other?
Yeah, do we need to? That's
right.
kind of
and right now, they don't see the need to pump the money into the mortgage-backed securities. So the free market is basically running the show.
Good stuff, Mike. So I went into, if you're a buyer out there, right, and you're kind of interest rate conscious, there's obviously other things going on, but if just such an important reason why you want to align yourself with a mortgage expert like Mike Overson over at Illuminate Home Loans is because, and another thing that some data that was provided from NAR, it kind of comes down to the delayed sellers cannot wait longer. Locked in effect to be less strong over time, meaning that these sellers who are locked into these COVID era rates, there are 3.5 million newborn babies a year in America, 1.5 million marriages, 700,000 divorces, 3.5 million turn 65 years old, 2 million deaths, and 25 million job switches. So every one of those bullet points, those are major life events, and typically major life events open up opportunities for increased inventory. Things of that nature from these sellers who are really sitting into these locked in rates. And I think they're going to see some great opportunities. Sellers are. They say, hey, I might have a 3.5 today or a 4 today, but I got this new job, or I just got married, or we have a baby coming. We're going to part ways with the home that we have today, and we're going to sidestep or move up or move down or whatever the case might be. And that's going to bring some relief in our inventory. So I think that if you're a buyer out there, you're going to have some great opportunities to get a great rate here in the upcoming months. And, there's going to be some great opportunity for some better inventory too.
Yeah, I've been having this conversation with a lot of people lately. It's like, if there's a deal to be had, right, in the Midwest on a house, it's more than likely going to be coming in November, December, and January, right?
Yeah.
Because there's typically less buyer competition out there, right? Sellers who have been sitting on their house going into the winter, it can get downright cold, it can get snowy, it can suck to move in that type of weather condition. So then, how many people... how many buyers want to get out there and buy a house and then move during that? So first-time home buyers, anyone who's not on a timeline, it's like, we know we want to buy a house, but we're not pressed for any sort of time. It's a great time to make sure you get that search set up with your real estate agent, because you're probably going to see some deals come across the door, right? It's like, hey, there's a price reduction on that one, and then it's going to be like, oh, I never thought we could get that type of house for that price, right? And then now you
Yep.
can go take a look and you can make a move, and you're not going to be competing with the amount of buyers that are going to be out there if you would wait till the spring.
Yeah. Yeah, I agree. Definitely agree. And I mean, I know you gave us a good plug, Mike, to sit down and with your realtor and create a strategic plan. And like I said earlier, I mean, it's equally as important to have that conversation with your mortgage broker like yourself. And because I mean, it might be something where you have a buyer or a couple, and they have exceptional job security, and very low debt, and they might be interested in saying, "Hey, we have, we're very confident that our careers are going to be improving in the upcoming years because we're young in our careers, and so we want to, buy as much, take advantage of our buying power." And it's like, well, if your rate improves by half a point, you don't really need to do anything other than shop for, a better priced home in terms of maybe something, amenities that you really wanted. Well, now same monthly payment, but more expensive home, and you're going to be good to go.
Yeah, I just had this conversation with actually one of our mutual clients last night, Marcus, of, here's where rates are at now. Here's how much you qualify for now. If rates go down by 1% between now and when you actually lock in, here's how much more of a house you can get. In their particular situation, it was about a $55,000 swing in price.
Yeah.
And a $55,000 swing can put you in a completely different bracket of home.
It definitely can. I mean, you really need to get into like that entry level luxury before 50,000 may not really make a big difference from one home to another. But if you're, obviously if you're a first time home buyer, that's huge. And even if you're a move up buyer, a second time move up buyer, those are large increments. And so you're definitely getting more amenities, more features, and usually checking more boxes.
Yeah. So it was a good conversation. It was fun to see like their eyes kind of light up a little bit, because it's like, well, yeah, a 1% decrease in interest rates. Yeah, I'm going to qualify for more, but really, what does that mean? And then I was like, oh, let's run some numbers, plug it in, and it's like 50. Now you can go up 55,000 on your purchase price, and it was just like that much. Yeah, it was like that much. It's like, oh, like dang, that's I mean, that thing moves the needle.
Yep, definitely moves the needle.
So. Well, good. Well, we appreciate everyone watching us and listening to us today. You can catch us at any point during the week, ushometalk.com. Any previous shows that you want to watch or connecting with us throughout the week is right there and available to you at ushometalk.com or anywhere else you guys get your podcasts. On behalf of Marcus Walgrave from the South Dakota Home Team with Hague Realtors, I'm Mike Overson with Luminate Home Loans. We'll see you next week.